Hey, what's up? We're going to try to dive into Trump's taxes here. Now, I'm going to hit some of the biggest issues that I think have been lingering, have come up with this New York Times article. Did Donald Trump only pay $750 in income tax for 2 of the years? Is there tax evasion or tax fraud here? Is he doing something wrong? Also, along with that, are there questionable expenses on his tax return? Is he deducting things he's not supposed to be deducting? And then kind of the one thing people have always wondered, he uses a lot of debt, he's been bankrupt before, he's got losses. Is he even a good businessman? Is he good at what he does? Is he actually as wealthy as what he says he is? He's got all these business losses. What's the deal? Is he good at what he does? Now, I do have notes this time around. Usually I don't really have any. Sometimes I have a couple. But there's a lot going on here. This is super involved. For instance, the New York Times article mentions that there's over 500 entities. 500 entities. Now, you spread that out over multiple years, and you're talking thousands of potential tax returns here. Okay? The New York Times article said they don't have his personal tax returns for 2018 and 19. That's kind of the first question I want to bring up because, again, the New York Times says we don't have his 2018 and 19 personal tax returns, and yet they say in 2018 the records show that his bottom line was a $47 million loss. How do they know that if they don't have his personal returns? Now, again, there's multiple things here. There's business returns, and then there's his personal return. They don't really give any breakdown of the types of businesses those are. If they are C corporations, they file their own tax return. They pay taxes on the net income or they have net loss. And that does not carry over to the personal tax return. A partnership, LLCs taxed as a partnership, or LLCs or corporations taxed as S corporations, those report on their own tax return, have net income and net losses, but they don't pay their own taxes. They flow through to the owner's tax return and you pay taxes at the owner level. It sounds like a lot of these entities are flow-through entities, whether partnerships or S corporations, because the article talks a lot about losses, business losses taken on Donald Trump's tax returns. Again, they don't really ever specify if it's an entity or him personally paying the taxes here. They don't really go into that, so I can't speculate on that because they haven't released the actual tax returns. I have not seen the actual tax returns. Like you, I'm basing this solely on articles that have been written and derivative articles from this main New York Times article where they say they have over 2 decades of tax returns for over 500 entities for Donald Trump. So let's jump in and answer some of these questions. All right, so I covered this, so I'm not going to cover in another video, and I'll try to put the link here, so I'm not going to go into too much depth. But did Donald Trump only pay $750 in 2 years for his income taxes? All right, I'm going to tell you, I don't really care. I really don't care about his tax returns in general because I don't think that this has anything to do with him being president. Now, there are some questions here, like you say, okay, is he getting money from foreign sources? Some of that clearly would have an impact on whether or not, you want him to be president. But some of this stuff, like, is he a good businessman? Who cares? I know that he's campaigned on this, but to be honest, some of these things we're going to see aren't going to answer that question. But $750 in 2 years, okay? Why does that not matter? Well, the New York Times article itself says that from 2005 to 2007, that's 2005 to 2007, Donald Trump paid $70 million in income tax for those 3 years, okay? So why am I not concerned about the $750? Well, I don't care who you are. If you have your tax return and you're filing it in 2011, 12, 13, 14, 15, and you have a job making $500,000 a year and paying $150,000 in taxes for 2010 and 11, and then you get fired and you have no income in 2012, you're not going to pay any tax. You have no income in 13, you're not going to pay any tax. You now have $50,000 and you pay $1,000 in tax, and then in 2015, you have a job making $1 million a year and you pay $300,000 in income tax, are we going to look at 2013 and 14 and say, oh my gosh, this person making $1 million a year only paid $1,000 in income tax in 2013 and 14? No, because this year is a standalone year. You pay taxes based on what you make. Even if he saved this $1 million and had $1 million in the bank, $1 million, the years you don't make any income, you don't pay taxes. It's an income tax. It's not a net wealth tax. So it doesn't matter how much you have. It doesn't matter in 2015 if you make $1 million, if you didn't make anything in 12, 13, 14. You're not going to pay tax on it if you don't make it. So that's why I don't really care if you only paid $750 in these 2 particular years, because the Times article itself admits that he paid $70 million in taxes from 2005 to 7. So what does that mean? That means that's the year he was making money. He wasn't making money in these years. You can't make money and not pay income taxes. Now, there's deductions, there's credits, but I'm telling you, they're not going to fully wipe this out. And the deductions and credits cost you an outflow of cash. In order to get a deduction, say a charitable contribution deduction, you have to give money to a charity. So if you give $1 million away, you no longer have it, but you might offset some of your taxable income. But I have another video on that. I'll try to put that link up here too. What is the tax code? What are these deductions? They're really just to motivate people to do things. So to motivate Donald Trump to not just keep $1 million for himself, but to give it to a nonprofit, we're going to allow him a deduction. I also go into, in another video, again, I'll try to put a link up here, for the other video of how it's actually beneficial to give the wealthy a deduction, because it generates more money flowing out from them instead of them keeping it than actually simply taxing them. So check out those other videos because they go into this in a little bit more depth. But that's why I don't care that he only paid $750, because you can't take 1 year as a standalone. You got to look at all the years. You pay tax when you make the money. All right, the next thing goes into these 2 things together: tax evasion and fraud and questionable expenses. The New York Times article, and this is where I would say I don't like the article, but it's what journalism does, and I actually will concede the fact that you need to do this in journalism, is they're going to use emotional language. They're going to use rhetoric. They're going to not really look at just the bare facts, but they're going to stir up your emotions, and they're going to make assumptions. I don't really make assumptions because I'm talking about the taxes. I would love to see the actual tax return. I went through Joe Biden's tax return. Link up here again. I went through that, and it's so much easier than this video because I actually can see the tax return and give you an objective opinion. I can't do that here because I haven't seen the tax return, but I can go off of what the New York Times is speculating and try to turn that into an objective opinion like I did with the $750 here. So the tax evasion, tax fraud, questionable expenses. The ones that they raise questions about, all right, the biggest one, other than kind of what's become the line of you've only paid $750 in taxes, the biggest one has been the $70,000 for hairstylists. Now, the New York Times, again, this is where you're using language to stir things out, said he paid $70,000 for haircuts, okay? Like you and I, we either cut our hair at home or we go to Supercuts, we get our hair cut, we're sitting there thinking $70,000 in haircuts, this is ridiculous, okay? Well, if you read the article, one thing is they're not getting haircuts, it's hairstylists. I mean, if you think about people in Hollywood, you think about the fact that he was on The Apprentice, which is the years in which they say this relates to is when he actually was on The Apprentice. So it makes sense that there would be hairstylist cost. The $70,000, it's over 13 years, okay? So you divide 70,000 by 13. Now they accumulate it all together and just say the 70 because it's a big number and it makes you go, what? And that's what they wanted. They wanted your reaction. But over 13 years, you divide it out. Okay, that's less than $10,000 a year, all right? It's still a lot, don't get me wrong. I'm not paying that for a hairstylist. But it makes it a little bit more digestible for a Hollywood star who's on TV to be paying a hairstylist $6,000 a year, maybe, for what, 10 to 15 episodes of a show? Not only that, but I enjoyed The Apprentice, not necessarily because of Donald Trump, but I enjoyed the premise of the show. I watched probably all of those 13 seasons because I liked the business aspect of it. His daughter was on that show. Both of his sons were on that show. So depending on how this was structured, this could be hairstylist for multiple people over multiple years in an industry where, take whoever your favorite actor is, they're spending a ton of money. It's what they do. They're wealthy. They're spending a ton of money. So to speculate that these are questionable expenses or things that shouldn't have been deducted, therefore rising to the level of tax evasion or tax fraud by deducting these expenses, is really a big leap. Okay. Now, the New York Times even goes into, well, typically we interviewed someone from NBC. Most of the time, these things are reimbursed from the show, so he shouldn't be deducting him. So that is all complete speculation, and that's what I'm trying to help you avoid. It could be true, but it might not be. And the whole article basically leans towards assuming that he shouldn't have deducted these. Okay. Well, it also says that they interviewed people from the show who were hairstylists that said Donald Trump, it appeared as if he was getting ready somewhere else, and he wouldn't let us touch his hair. Okay, well, that actually lends credibility to the fact that he deducted his own hair care expenses because he wouldn't let the NBC hairstylist touch his hair. So he was getting it done somewhere else. I assume Ivanka was too because she was on the show. Maybe his sons were as well because they were on the show. So it actually leads credibility to the fact that he's deducting it. Now, hairstylists, you think that's a personal expense, you can't deduct that. Well, when you're on TV, it becomes a business expense. There are things like this, for instance, that can become business expenses that seem personal if they're related to your business. It's all about the facts and circumstances of what your business does, and is there a justifiable reason for this expense in order to generate the income. So we don't have all of those details. The New York Times doesn't necessarily have all of those details, even though they have tax returns. So it's very hard to speculate here on that. And so I think that a lot of the expenses they bring up in this actually fall into that category as well. And they even, again, shot themselves in the foot by saying that Donald Trump seemed to have been getting his hair done somewhere else. That lends credibility to the fact that he deducted. He's probably got a business. He set up a business that is involved in The Apprentice. The NBC might be paying the business, might be paying him. Who knows how the deal was structured? But that business looks like it's potentially deducting hairstylist costs for the people that are part of it. And so it's hard to say that that should completely be thrown out. Now, I get it. Your emotional side is still saying this is a ridiculous expense. He's taking advantage of things. All right, we're going to get into that a little bit more of this taking advantage of tax loopholes as well. All right, now we got the good businessman and losses. All right, losses are going to come into play here too with how he's probably, not paying income tax some years, only paying $750 in income tax some years because of tax losses. All right, so this kind of goes for you as well. I mean, this isn't anything that is just allowed for the rich, okay? So let's say you have a W-2 job and you take home, after taxes and everything, let's say you take home $100,000 and you say, all right, I've got this $100,000 and I really like pets and I'm going to open up a dog spa. So I'm going to dump this $100,000 into this dog spa, but you suck at running a business, and so your dog spa loses that money, all right? Now, you've put that money in. That's not revenue. That's capital contributions to that. So let's say, there's $0 in revenue, and you spend all that $100,000 on, getting supplies for the dog spa, advertising, website, marketing, all legitimate business expenses. You spend the $100,000, so your business shows a $100,000 loss, okay? Well, you've got your W-2 income over here, and now you've got your business that you ran into the ground, and it lost money. But it was a legitimate business. You had an intention to make profit. Maybe some years you made profit, and this is just the year where you didn't. But that $100,000 is going to flow onto your tax return as a loss, and your taxable income will be $0. So you'll pay 0 in tax. Taxable income, 0 in tax. That's how it works, because we're taking all of your income and all of your business losses and we're putting them on your tax return. So a business loss can offset income. Now think about this, 500 entities for Donald Trump, okay? We know, the article said that Donald Trump made $427 million from The Apprentice. It also says that from 2 highly successful office buildings, he made another $177 million, all right? So that's going to be 604. Now, I'm not great at mental math, so forgive me if I did that wrong, but that's 14, that's 10, that's 6. $604 million that he made. Okay, that is a lot of money. You can live off of $604 million for a long time. You can also fund a lot of crappy businesses, okay? And that's one of the things the article mentions, okay? It says that his golf courses, that's what that says, trust me. I suck writing on this board, but golf courses, okay? He's got a lot of golf courses, and according to the Times article, a lot of them lose money, and they lose a lot of money. So he's taking this money, and he can fund a lot of things here. He's funding golf courses that are losing money, all right, at a high rate. He paid tax on this, remember? So if you go back, we talked about, they said from 2005 to 7, he paid $70 million of income tax. That's not $70 million of income. That's the amount of tax he paid. $70 million in tax for those years. So he's paid the income tax. He's now using that money to fund businesses that you could say are failing. They have business losses. We get a little bit more into, are they real losses? Is he able to make money but show a tax loss? What about depreciation? I'm going to go into that briefly as well. But, okay, he's losing money. There's nothing wrong with this. You can take the money you made, fund a losing business, and it can offset taxable income. I don't know what else to say, other than this is how the tax code works. Is it better? Is it benefiting wealthy people more than other people? Well, not necessarily, because, if you're not wealthy and you can't do this, you're only making $20,000, $30,000, $40,000 a year, you're paying no income tax. 40 to 50% of taxpayers pay no income tax after the standard deduction, child tax credit, earned income tax credit. Some of those people are even paying effectively a negative tax rate because of the earned income tax credit and some of these refundable tax credits. So you're not really paying anything. So we kind of get into that a little bit. Now, the article says that, he's propping up losing businesses with this money. Okay, there's nothing wrong with that. You can have businesses that are horrible and you can prop them up with money you have. Again, you could do this. As long as you keep making money, you could keep pumping it into your dog spot and losing it, okay? The thing is, though, you're not building any wealth. You're not getting any wealthier because you're taking all your money, pumping it into this dog spot, spending it, losing it, and paying no tax. So sure, you're making $100,000 and paying no tax every year, but you're spending that money into this business, which is actually pumping it back into the economy because you're spending those resources on the website and the marketing and hiring people. Maybe you have employees and you're just not making any money here. So it's not necessarily a bad thing, but it makes sense that you're not paying tax there. I mean, you're not building any wealth. You're just using your money here on a business that's failing. So it seems to be, from the article, that's what Trump is doing. He's had some success, mostly through being a celebrity, not necessarily through business, and made a ton of money that he's now pumping into losing businesses. There's nothing wrong with that, to be honest with you. Which gets us down to our last question of, is Donald Trump a good businessman because of his losses? Well, look, you can have one business, all right? You can create the Walmart that just blows it out of the water and is an amazing business, but you've got some other ideas that you like, or you have friends who have businesses that you want to invest in, or you have kids who have businesses that you think, I want to help them out, and you invest in those things, and they're losers. They're bad businesses, and they lose money. You know, the more money you have, the more you're going to invest. You might be investing a little bit in the stock market. You might just put it in a savings account at the bank, but try to put it in a CD so that you earn a little bit of interest, okay? I don't think that the fact that several of his businesses is losing money, we can base that on is he a good businessman or not. All right, the other thing this is going to get into is a business can show losses while still being a good business. Now, how is that? Let's go back and look at this, because this has a little bit to do with depreciation, and it also has to do with this. In this example, you were funding this business, but there's another option. The other option is you keep your $100,000 here, but you borrow from the bank $100,000. When you borrow money, that's a liability to your business. It's not taxable income because you got to pay it back. And then you spend it, so no revenue over here, but then you spend it on $100,000 of expenses and you lose $100,000. Now that still flows through to your tax return as a loss of $100,000, offsets your W-2 income of $100,000, and you pay no tax. All right. So in this situation, you kept your $100,000 and you generated a business loss that wiped out your taxes. Okay. And if you look at this as a standalone, then you say, wow, that's amazing. I'd like to do something like that. Well, the problem though is this can't be sustained. The bank is going to come looking for their $100,000. You're going to have to pay it back. So at some point, they're coming for that. So it might help you in 1 year, but you can't just look at it as a standalone year because you're going to have to pay that back. If you don't pay that back, now, it's been said that Trump's been through bankruptcy, etc. Now, if the bank forgives this loan, you say, hey, my business failed, and if for some reason they don't have recourse to come back and get it from you, that $100,000, when they forgive it, let's say it's the next tax year, when they forgive it, cancellation of debt or loan forgiveness is taxable income, okay? So that will then become income. You'll have no business expenses, and so that year you'll report $100,000 of business income that'll flow through to your return the next year. You still have your W-2 wages. You don't have this loss though. Now you have income of $100,000. Your total income is $200,000, and now you're going to be paying $60,000 in tax, let's say. So, it's coming back somewhere. You can't escape it forever. And that's why when I mentioned at the beginning, the $750, you can't look at standalone years. You got to look at the whole picture. All right. The last thing on the taxes I want to jump into is depreciation. Okay. People say depreciation is a non-cash expense. It can create business losses where there's actually positive cash flow. One great example of this is rental real estate. Okay. I've talked about this in some of my other videos too, where it can be a great investment for you. And you don't have to be a millionaire to do this. I have plenty of clients who aren't making more than you probably, who are able to invest in real estate by saving up and borrowing some money, creating rental real estate. And what happens though is your real estate you might borrow money, so you're leveraging someone else's money. You're borrowing money from the bank to buy this house to then rent it out. Your cash flow from rent, let's say, is $2,000 a month, and your business expenses out, so take your insurance and divide it out, take your property taxes and divide it out, take the mortgage payment that you're paying on the loan you borrowed and divide it out, and say all those expenses are $1,500 a month. So $2,000 minus $1,500 a month is $500 a month of cash that is coming into your pocket every month. But we haven't taken into account yet the purchase price of the house. You borrowed money for the purchase price of the house. You didn't pay for all of it. So maybe you spent $20,000 and you borrowed another $180,000 on this house. Well, the full price of the house, $200,000. Now you got to break out land because it's not depreciable, but we'll ignore that for now. But let's say that house you're going to depreciate over 27 and a half years. Well, that depreciation is going to be $200,000 divided by 27 and a half. I'm not going to even attempt to do that in my head. But that's an expense that you can now deduct because you're deducting the cost of the house over time. They don't let you deduct it all in the year you bought it. They make you deduct it over time because it's an asset that's going to last longer. It's going to last over time. Think about this. You can deduct advertising expenses in the year you spend them because you spent them, they're gone, it's over, it's just an expense that's used up. But this house is going to last for a long time. So we're going to make you take the price of it and not deduct it all in 1 year, but spread it out. Okay? Well, that could create losses even though you've got cash flow of $500 a month. Now your taxable income might only be $100 a month, or even negative. You might have some losses from this rental property. Now that's a pretty big concept, I think, to wrap around. Hopefully that was decently clear, but that's what depreciation is. But if you buy equipment, say you bought equipment for $100,000 and you didn't borrow the money, well, you laid out the $100,000 and now you can only deduct it over 5, 7, 10, 15, depending on the type of property. You can't deduct that all in the year you bought it. So that actually hurts businesses because they're laying out $100,000 in cash right now, but they've got to expense this at $20,000 a year over 5 years. Well, that hurts them. So there's bonus depreciation, there's Section 179 expense that will allow them to deduct the full amount in 1 year. So you get to accelerate depreciation. It's actually good for business. Now, there's not really a way to take advantage of this. It's basically just letting you expense something in the year you bought it. It's treating it like every other normal expense. I personally don't see anything loophole or any kind of sketchy thing with that. That's in the tax code. It's allowed. Now, the other thing you can do is obviously you could borrow the money for that equipment instead of paying the cash out and then expense it all in 1 year so you get the write-off now and deduct it. Well, again, you're going to eventually pay that back. So it's not any way to get ahead because you got to pay it back eventually. If it's forgiven, it's going to be done this way. If you sell the asset, now that's the other thing with businesses. Once they depreciate this asset to zero, if they turn around and sell it for $50,000 a couple years later, the basis in it is zero. So they're going to have to report $50,000 of taxable gain on the sale of this asset. So it all, I mean, you're deferring, but you're not really escaping taxes here. There's business strategy here, but again, it's all in the tax code. So let's go now to, do the wealthy get preferential treatment under the tax code? Because a lot of times, I'm going to try to keep this nonpartisan, but a lot of times the Republicans are held up as the ones who are for the wealthy, giving the wealthy tax breaks, and Democrats are for increasing taxes on the wealthy and giving the tax breaks to the middle class and below for the average everyday person. Because again, the people who are making $500,000 a year or more, that's the top 1%. You start talking $1 million, $2 million or more, you're in the top half, top 0.1%. So again, 99% of people are nowhere close to making $400,000 a year. Well, again, the Republicans tend to have the persona that they're giving tax breaks to the wealthy, while Democrats have the persona that they're helping the everyday man and giving tax cuts to them while charging more taxes on the wealthy. Well, one of the big things, okay, I mentioned that $70 million in taxes that Donald Trump paid. Well, let's circle back to that because it says also that he actually was able to get that refunded. So now you're going to have to rewind, scratch that out. Yes, I said he paid $7 million in taxes, but it said he actually was able to go back and get a refund for that, so he didn't actually pay those in taxes, all right, because he got them refunded later. Well, how did he get those refunded? And this might shock you because it was under President Obama that Donald Trump was able to get the $70 million refunded. There was, I don't know if you're going to call it stimulus or, it was to boost business. It was to help people out who are business owners. Now, a business owner could be the guy next door to you who runs his own plumbing company. It could be me next door to you who runs his own CPA firm who's pulling in, let's say the plumber guy's pulling in $50,000, $60,000, $70,000 a year. He's living a normal, average life, living next door to you in your neighborhood. Well, perhaps he had some years where his plumbing business wasn't doing so well. Maybe like the beginning of this year, COVID hit or something. He was losing money because he still had some business expenses, but the revenue wasn't coming in. He lost money in that year. Well, typically business losses, let's go back. Your business losses can offset other income. Well, for the small business person, their only income is their business. So if they have business losses and that's the only income they have, you can't do anything with negative income. And so what the tax code allows you to do is say if you have business losses with no income deducted against, you can carry it forward. So Mr. Joe Plumber loses $50,000. His income is negative $50,000. He can't do anything this year. But next year, when his business bounces back and he makes $50,000, he's got that loss that he carries forward to offset that $50,000 of income next year. He'll pay no income tax that year, and then if he makes $50,000 the next year, he'll continue to make money. So this is basically to help people who have their own businesses say, you lost money here, and we don't give you any taxes back when you lose money. So next year, when you make money, we're going to let you take those losses and offset the money you make and pay no income tax next year. So that's a big piece of how Donald Trump has paid zero income tax for several years here is, again, there's the years where he had income and paid taxes. You have income, you're going to pay taxes. But there's years where his businesses have lost so much money that it's wiped out all of his taxable income, and he's been able to carry that forward to offset future income. Okay, again, no more available to Donald Trump than the plumber running his own business next door to you. It's all available to you. It's just a matter of scale of how much money you're making. Okay, this isn't just there for wealthy people. It's available to anyone. Now, let's get back to President Obama. What did President Obama do? Well, there's one way to get money back into, there's a couple ways to get money back into people's pockets. Remember, we just had this stimulus check. They passed the Coronavirus CARES Act stimulus check where they said, we're going to give you $1,200. Well, all that is it's basically, they created a tax credit that you're going to get on your tax return next year in 2021, but they've given it to you ahead of time. They said, we're just going to go ahead and give it to you now, so you have it. And then on your tax return, you're going to calculate for that and you're not going to get it back. But it's going to basically be a reduction of your taxes that you've already gotten in advance. So that's one way. The other way is to let people, these losses that I said you can carry forward, well, if you're carrying a loss forward, you don't get any benefit until next year or the year after where you start making money. President Obama increased the amount of time you can carry a loss backwards, okay? So let's take our same plumber and say he lost $50,000 this year, but he made $50,000 last year and paid $5,000 in taxes. So now I'm going to let him take that loss, carry it back, kind of like amending that return, carry it back, offset that $50,000, and get that $5,000 of tax that he paid last year, get it back as a refund. Okay? So it's the same thing as carrying that loss forward, but we're going to let you do it backwards so that you can do it today, not have to wait until your next tax return, do it today, and get a refund from what you already spent or paid in taxes. President Obama did this to help business owners, to help people, to help stimulate the economy, to get money flowing into the economy. He extended the amount of time you could carry a loss backwards. When he did that, it opened up more years, and he also, I think, increased the amount that you could, the percentage to which you could offset previous income. But what he did was he allowed Donald Trump additional years, and everyone else, but it applies to Trump. So Trump took losses in, say, 2009 or 10, carried them back to 5, 6, 7, or 8, whichever years it was, but to 2 or 3 years where he paid the $70 million of taxes on income that he had. Obama allowed him to carry that back, get the $70 million refund from carrying losses backwards. Same thing as carrying forward, but there you go. Democratic president allowed Donald Trump to take advantage of a tax loophole, okay? Now again, go back to that video where I talk about loopholes and deductions, especially the one where I think loopholes and deductions actually transfer more money from the wealthy to the common good for everyone else than just taxing them. So look at that one. But also just the general mindset behind what's the point behind this? Well, they're all to motivate behaviors, to motivate people to invest in business, to provide jobs. Now you can say Donald Trump doesn't treat his employees well. You know, I probably wouldn't be surprised by that, but he creates jobs. and maybe doesn't pay them well, but they are being paid. So that's the mindset behind this: is they're creating jobs, they're paying people, they're helping the economy. And so we get back to the bottom line of this kind of, it's not an objective black and white facts. So I can't dive into it. You still might think that Donald Trump is not a good businessman. He doesn't treat his people well. He's got more businesses that are being run into the ground than that are doing well. Now, when you go back to this depreciation too, the same thing there. Say you bought an asset. I'm going to touch on this real quick. Say you bought an asset for $100,000, and it wasn't really equipment that you're using up, but you've created this business. You bought the asset at $100,000, and the business is making some money. And you look at that tax return. The tax return is going to show what's in the bank. It's going to show the assets, but it's going to show that asset at $100,000. Take your rental property, for example. It's going to show your rental house that we said you bought at $200,000. It's going to show it at $200,000. As it appreciates, as you do well in business, as you create value, that's not going to show up on a tax return, because the tax return is not going to show the fair market value. It's going to show what you paid for it. So as that rental property increases in value, say it goes over 10 years from $200,000 to $400,000, so you've clearly made money on that, but maybe your income minus expenses were showing losses on your tax return. Was that a good investment? Absolutely, it was a good investment. Maybe it had some tax losses, but the house itself went from $200,000 to $400,000. You're not going to see that anywhere on a tax return until the year you sell it. So there could be value in some of these golf courses where, yes, they're showing that they're losing money, but perhaps the golf course itself, the value of it, if you were to sell it, is in the hundreds of millions of dollars. So it's possible that he's created value here. And he will pay tax on that. You're not going to get out of this. You can't evade taxes. When he sells it, he'll pay tax on it. You can't make someone pay the tax on it until they have the money, because, let's say you had to pay tax right now on your rental property. Every year it went up in value, but you don't have the cash to do it. So they wait until you sell the rental property, charge you tax on the gain, and when you have the money, that's when they make you pay the tax. It would be unfair to make you pay tax on the appreciation of your house every year when you're not actually seeing a cash benefit from that. So that's a lot to cover. That's kind of the gist of it. Now, there's some things we didn't cover again. Is money coming in? Like, okay, Mar-a-Lago, if that's how you pronounce it, saw new members, additional 5 million in revenue from new members who joined in 2015 when President Trump started running for president. Was this a way where they just joined the club to put more money in President Trump's pocket? Maybe, I don't know. To be honest with you, though, if they're joining the club to support him, there's still a business reason. It's still income. It's still, if it's income, it's going to have to be reported on a tax return. So there's nothing crazy there. The Billy Graham Evangelistic Association, where they had their event at one of his hotels, they paid about $400,000 to have that event. Was this a way to funnel money to him? Not really, because there was an event. They paid for it. That will go on a tax return somewhere. Maybe there's some business expenses kind of offsetting it, but it's all there. They're basically saying it was reported. There's nothing fraudulent or wrong with that. It was reported, okay? Or some of his business investments making him impartial to running the country. That absolutely is possible. I don't know what to say about that, but that's possible. But again, it's speculation. I don't know. I don't go into speculation, but these things are possible. And I get that's where the biggest issue is here, And again, he's touted himself as a billionaire. He said in the 80s, I'm a billionaire. He says he's a great businessman, and he utilizes strategy, and he does this, and he's great. He's always talking about himself. He wants to be seen as a successful man. Well, whatever. I really don't care, to be honest with you. I don't follow Hollywood actors. I don't follow celebrities. That's all this is celebrity talking to boost up his image. Is he lying? I guarantee you he's lied at some point about those things. There's no harm in that. Now, when he brings that into the Oval Office, if he's lying about policy, which I know many people think he is, I don't have proof of that, so I'm not going to go there. But it's very likely he's still lying. Then there's issues there. Absolutely. My point is, I'm a CPA. I'm talking about the taxes. There could very well be tax evasion and tax fraud. Apparently, the IRS is auditing him. They're going to go through the receipts for the $70,000 of hairstyles. If there's not a business purpose, they're going to throw those out. He's going to have to pay penalties and interest. And if it rises to the level of tax evasion, they're going to put him in jail. The IRS is impartial. They're going to do this, okay? If that's what's the case. So we leave that up to them. But I can't speculate on it because we don't have the details. The New York Times has a lot more details than we do, but even their speculation, in my opinion, of reading the article, goes way beyond objective facts about the situation. You've got to leave that up to someone who's going to audit it and find out if the business expenses are legitimate. You can't just look at it and say they don't sound legitimate. Okay, it depends on the business you're in. You know, that's how this thing works. That's not my job. My job is to bring you the facts of the tax returns, okay? I'm not a journalist. I'm not going to try to hype up your emotions or anything here. I'm giving you the facts and situations. Does any of this make Donald Trump a good president? Look, again, that's not what I'm getting into. I'm staying nonpartisan. I'm not trying to attack or promote Democrats, Republicans, or anyone else or any particular candidate. I'm just simply telling you the facts about this, and I think that this clouds that, and I think we should stay away from it. And look, if you come to me as your CPA, I'm going to take every deduction and tax credit that you qualify for. Absolutely, you want me to. You want me to say, oh, your kid's in college and you qualify for the American Opportunity Tax Credit for college tuition you paid? Let's not take that. That's reducing your taxes. It's a loophole. You don't want to do that. You don't want to be like the wealthy in these loopholes. No, it's crazy. We're going to take the deductions. Now, if you think the law should change, okay, that's when you get into a realm I'm not talking about again. That's when you're voting for the Democrats, Republicans, or candidates, or whoever that you agree with on what the law should be, all right? I'm not getting into that. What I'm saying is what it is right now. If you qualify, if you have a business where you can deduct hair care, hair stylist, if it's a legitimate business expense, I'm not going to tell you, don't do that. It looks bad because it looks personal. No, I'm going to say, is it legitimate? Does it have anything to do with your business? If so, let's deduct it. Why are you going to pay more income tax than you have to? You're only required to pay the amount of income tax that you're legally required to under the law. We're going to take the deductions you're allowed. We're not going to just pass on. Donald Trump's doing the same thing. These are laws that if he didn't break, which again, I don't know, you don't know, you're speculating, you're basing it on the New York Times article that is also speculating, the IRS is going to dig into that as far as anyone possibly can. It's possible he could have done tax evasion and not get caught by the IRS. That's possible as well, okay? But again, you're churning up your stomach, you're getting yourself into a fuss over stuff that you can't prove that you don't know about. You're just speculating, okay? Again, the tax code, it is what it is. Vote if you want it changed based on candidates who agree with how you want it changed. But you come to me, we're not going to pay more income tax simply because you want to. I mean, if you want to, we can. We don't have to take the deductions, but I guarantee you're going to come in and say, take every deduction I can. And that's what we're going to do because you're not going to voluntarily pay more income tax than what you're legally required to. We're going to take those deductions. They're not loopholes. It's not taking advantage of anything. It's simply following the law. We're following the law when we take these deductions and credits that you qualify for. My name is Brad. I'm with Gluten CPA. My goal is to bring peace to your finance and tax responsibilities. Don't forget to check out the other videos. Please subscribe and hit the bell so you're notified when other videos come out. And I appreciate your time. Thanks for watching.